Could be natural disaster, terrorism, or vandalism among the company. Business disruption and systems failures, which could be utility disruptions, software failures, or hardware failures. And the final operational risk could be execution, delivery, and process management systems within the company, which could be data entry errors, accounting errors, failed mandatory reporting, or negligent loss of client assets. Within this section, operational risks, you could attribute 3, 4, maybe all of these examples to what has happened to many of the banks like Citibank, Bank of America, and Wells Fargo, and why they find themselves in such great troubles during these economic times.
Tools and techniques. In this session, we will introduce some tools and techniques adopted by banks and financial institutions in dealing with asset liability management. First, we will discuss net interest margin and interest rate risks. Then, we will talk about interest sensitive gap management and duration gap management. Net interest margin. Banks operate by borrowing money from many funds and lend out to customers. When they borrow money, they have to pay interest costs. When they lend out, they make interest income. The difference between interest cost and interest income is net interest margin. It is very important for banks to keep net interest margin positive to remain profitable. Interest rate risks. It is crucial for banks managers to understand how changes in interest rate affect the value of the bank's assets and liability. We all know that assets generate interest income and liabilities generate interest costs. When interest rate change, it affects both interest income and interest costs. However, they don't always move together. For example, if interest rate go down and increase interest income and interest costs, but interest costs move up faster than interest income, the bank actually makes less money and it creates interest risks. To deal with interest rate risks, banks use interest sensitive gap management. Interest sensitive gap management look at the relationship between interest sensitive assets and interest sensitive liability. Interest sensitive assets are loans that can be repriced when interest rate change, such as loans that are about to mature or short-term loans. Similarly, interest-sensitive liabilities are short-term debts or CDs. The difference between interest-sensitive assets and interest-sensitive liabilities is called interest-sensitive gap. The following table shows you the characteristics of interest-sensitive gap. If the gap is positive, then the bank is said to be asset sensitive and its net interest margin moves along with the interest rate. If the gap is negative, the bank is liability sensitive and its net interest margin moves opposite to interest rate. If the gap is zero, then the bank is said to be insulated from interest rate risks. Another way to look at interest sensitivity gap is by using interest sensitivity ratio. It is computed by dividing interest sensitive assets by interest sensitive liabilities. If the ratio is greater than 1, then the bank is said to be asset sensitive or positive gap. If the ratio is smaller than 1, the bank is said to be liability sensitive or negative gap. If the ratio is equal to 1, the bank is said to be isolated from interest rate risks. Banks managers can take advantage of the changes in interest rate to increase the value of the bank's portfolio. When they think that interest rate gonna go up, they increase the value of interest sensitive asset and decrease the value of interest sensitive liabilities to have positive gap. And they do the opposite way when they think that the market interest rate gonna go down to have a negative gap and benefit from the changes in the market. Even though it is a good way to deal with interest rate risks, Interest-sensitive gap management also has some problem. It doesn't fully protect the bank's net worth from interest rate risks. To look at this, we had net worth is equal to total assets minus total liabilities. However, assets are used to make long-term loans while liabilities are borrowed from short-term debts. So when there are changes in the market, debt rates tend to move faster than interest income rates, and it reduces the bank's net worth. This problem can be solved by using duration gap management. Duration gap management is a value and time weighted measure of maturity. It shows the average time needed to recover the funds borrowed for an investment. This is the formula used to compute the duration of an asset or a liability. The numerators is the expected cash flow of a given time period, while the denominators is the current value of the assets or liabilities. Usually, banks calculate the duration of their assets and liabilities and try to make them equal to be insulated from interest rate risks. To illustrate the way durations are computed, we can use an example. Suppose that a bank makes a loan of $1,000 for 5 years with 10% interest and annual payment is 10%, which is $100. The duration is computed by dividing the cash inflow from the loans in the next 5 years by the par values of the loan, which is $1,000, and we can get the result of 4 years of this loan in terms of duration. After knowing the duration of assets and the duration of liabilities, managers calculate duration gap to control interest rate risks. Duration gap is equal to duration of assets minus duration of liabilities. However, the value of assets is usually different to the value of liabilities. That's why we need some adjustment. The adjusted duration gap is equal to duration of assets minus the adjusted duration of liabilities. Duration gap show how the bank's net worth would change according to the market. If duration gap is positive, net worth go opposite to interest rate. If duration gap is negative, net worth go along with interest rate. And if duration gap is zero, the bank is said to be insulated from interest rate risks. Banks managers can use duration gap management to take advantage of any changes in the market. In rising market interest rate, they decrease asset duration and increase liability duration to have negative gap. In falling market interest rate, they increase asset duration and decrease liability duration to have positive gap. This way, they can increase the value of their portfolio with any change in the market.
So far, we have introduced to you different aspects of asset liability management. We hope the information is helpful for you. Goodbye and see you again.